everyone, welcome to today's video. Today's video is the continuation of the previous video. In previous video we talked about the very basic concepts of portfolio. So what is portfolio and what are the activities of portfolio manager, etc. So in this video we will be covering some of the important theories under portfolio management. So throughout this video we will be talking about three theories. One is efficient market hypothesis, and secondly we will be talking about random walk theory, and finally we will be covering Markowitz model of risk return optimization, which is one of the very important portfolio management theories. So let us start with the efficient market hypothesis. So first of all, this talks about the market efficiency. So how this market efficiency is determined? The market efficiency is determined based upon the stock prices. So the stock prices should be adjusted instantaneously towards the information available in the stock market. So if any new information comes into the market, the stock price should behave in accordance with that information. So in that case, one can say that the market is working efficiently. So to put it in words, a stock market is said to be efficient if security prices adjust instantaneously. So if it adjusts instantaneously and in an unbiased manner to any new information released to the market, and hence always fully reflect all available information concerning the securities traded. So something is out there is going to affect the stock price. If yes, it is going to affect the stock price, then it is efficient because we can rely on something to take our decision. So that is how this hypothesis works. So under efficient market hypothesis, market can be segregated into three forms of efficiency. One is weak form, another one is semi-strong form, and the last one is strong form. So what is the weak form of efficiency? The weak form of efficiency is something under which the stock prices reflects only the past information. So it doesn't have any present information. When it comes to semi-strong form, the stock price movement will reflect the past and also the present information, and this present information is something which is publicly available. And when it comes to strong form, it is having the past information and also the present information, and this present information is not only publicly available and it is privately held, so one which is more reliable. So to put it in words, when it comes to weak form, security prices reflect only the past information on stock price movement, and when it comes to semi-strong form, apart from past, all present publicly available information is reflected on stock price. When it comes to strong form, all information include privately held inside informations are reflected in stock price, so which makes it more reliable. And also it is to be noted, even though we are able to decide what form of efficiency the market is in, it is not sufficient. There should be always analysis needs to be taken before making an investment decision. So let us move on to the second theory of today's video, which is a random walk theory. As the name suggests, we don't have any solid information with us and the informations are random. So how it's gonna work? So stock price behave in a random and patternless manner over time. Random walk theory, they are saying that the stock price behave in a random manner and there is no pattern over it. So whatever efforts we put into, to find out the stock price, how it's going to be in the future based upon the past information is fruitless. So in short, any tools with assumption of dependencies in stock price over time may not be useful to predict the future stock price movement. That means they are saying if you're going to pick any tool and that tool is saying, see, based upon the past stock prices, it's going to rise this percentage, then you should not rely on that particular piece of tool, because they are saying that based upon random walk theory, the stock price movements are random and patternless. Out of it, you can't come into a conclusion. Now, moving towards our last theory of today's session. So it's about Markowitz model of risk return optimization, one of the important theories under portfolio management. First of all, who found this model? It's Harry Markowitz. He's also termed as the father of modern portfolio and found this model called Markowitz model of risk return optimization. The very important combination called risk and return is being analyzed under this theory. Moving forward, under what basis this combinations is being used? First, there are two properties of an assert. If you take an assert, that assert will have a two property. One is risk and another one is return. No assert or stock comes without a risk. So investors, whenever they're going into a market, so these investors should be concerned about their risk also, because every time it is being advertised this particular stock will yield you the X percentage of returns. But investors' decision should always be based upon the return and also the risk. So the investor should be concerned on the two properties of asset. One is risk and also a return, not only on return. And trade-off between risk and return. So how we can come to an indifferent point of this risk and return? How we can reduce our risk and can maximize our return? So an investor should be at a point where he can trade off between risk and return by diversification of portfolio. So this is why portfolio is favorable to investors. It's collection of investment. It is not holding a one particular stock or an asset in your bucket. It's a collection of investment, different types of investments, stocks, debts, bonds, etc. and etc. So with help of the diversification of portfolio, investor can achieve the trade-off between the risk and return. The last point is, the last basis is that focus of balancing safety, liquidity and return on the preference of different investors. Always keep in mind, for a particular individual, the preference of investment changes based upon lots of factors such as age, such as their earning capacity, such as their risk-taking appetite. So, Mr. A is satisfied with a portfolio A doesn't mean it is going to work good for Mr. B, considering different factors of his preference. So, the 3 points here is two properties of asset to be taken care whenever there is an investment decision. The two properties is one is risk and another one is return. One should not always be concentrating on the return. One should also analyze what are the risk investment is carrying on. Then one should also know to diversify their portfolio in a manner that there is a trade-off between the risk and the return. And finally, the focus should also be given on the various preference of the investor. So this is the basis. Let us move towards the application. What is the application? Here, application in sense how we going to use. Use is the context of application here. So how we going to use this? So the very particular usage of this model is that it will help the investor to select the efficient portfolio. If I'm just going to give option A, option B, option C portfolios, then based upon the preference of an investor, so which will be the efficient portfolio can be found using this theory. Moving to the next important concept, assumption. Whenever there is a model or a theory, one should be really concentrating on the assumption. Based on what are the assumptions this theory is being built. So let us go through the assumptions one by one. So the first assumption is the risk. So here they are saying that the risk is nothing but the variance or standard deviation of the return. So just let us go and see what is a variance or a standard deviation to understand it. So in the layman term or in a mathematical term, variance is the measurement of difference between the average of data set from every number of data set. So if I'm having a data which is consisting of 10 years of return. So now I'm going to compute the average of this 10 years of return. So I will be getting one value. Let us take this value as A. So now I will be using this A against each of these 10 years return and I will be finding differences. So that is considered to be your variance. So we all know what is a standard deviation. Standard deviation is your sigma. Sigma is a degree of variation of individual items of a set of data from its average. So which is nothing but the square root of variance. So we have already discussed this in detail in capital budgeting decision, where standard deviation is used to calculate the risk associated with the estimated cash flows for a project. Since it is a return year, so we will be computing the risk associated with the estimated return from any of your portfolio. I will ping the standard deviation link to this video. So if you want, you can just have a look at it. Let us move to return. What is a return? So return is adequately summarizes the outcome of an investment. So I've just invested 10,000 rupees and span of certain time period, how much it is increased. How much is the outcome? It doesn't mean always it must be increasing. So that's why it is being termed as the outcome, not increase. Okay. So it can be a loss or it can be a profit to me. So whatever is the outcome, so that is considered to be my return. So the third point here is investors' investment decision based on two criteria. So one is, as we already discussed under the point B basis, there should be two properties to any asset. So one is return and another one is risk. So when we come deep into it, the return is nothing but your expected return, because when you do an investment at that time, you don't know what is the exact amount of return you're going to get. Example, let us consider a fixed deposit. In fixed deposit, I know this is my percentage of interest, so it's if at the end of the 1 year I will be getting this amount of interest. Whereas when it comes to the investment in portfolio or any of the stock markets, you can't say this is going to be my return. So that is the reason, if you see throughout the portfolio, we will be using the term expected return and not return. And secondly, we have to consider the variance of return. So as we discussed the first point, risk is nothing but the variance or standard deviation of the return. So I expected this much, but I didn't yield this much, so the difference is considered to be the variance or standard deviation. So that is considered to be risk. So here, throughout the Markowitz model, we will be talking about expected return and also the variance of return. Variance of return or standard deviation of return is nothing but the risk. And fourth point is investors are risk averse. That is, they want to take minimum risk and they want to have a higher return. For each point of risk they take, they need a return. So this is termed as a investors or risk averse. Moving to fifth point, which is read as investors as rational. So you know what is rational mean. Rational means it is based upon the logic. So here the assumption is that the investors are assumed to be rational, making the investment decision logically. So moving forward, sixth point states that return could be any suitable measure to monetary inflows, but yield has been the most commonly used measures of return. That is, as we discussed earlier, we should consider the expected value, the expected return, not the return itself. And moving to the last point, which talks about investors' risk estimates are proportional to the variance of return. That is, variance of return is nothing but the risk. I have an expected return. I expect a return of 10%. But at the end, I'm getting only 8% of return. So now the variance, the difference is 2%. So that is the risk. Now, diversification and efficient portfolio. So what Markowitz model is talking about the trade-off between the risk and return. How are we going to do the trade-off? It is based upon the diversification of your portfolio. So to do that, there is a method is being provided. This is one set of graph based on which we will be finding what is the efficient portfolio that needs to be picked based upon our risk and return. So we will be seeing three terms here. One is efficient frontier, then we will be talking about what is the optimum portfolio, and finally the diversification. Let us jump into efficient frontier. So Markowitz developed the concept of efficient. So after not even with this theory, so the conclusion of this theory, he just gave us the solution to. So how one should pick the portfolio. So with the help of an efficient frontier. So what is an efficient frontier? It is a selection of a portfolio by comparison between combination of portfolios. That means if I am an investor, I'm not going to jump into directly into a decision. Okay, I'm going to invest in portfolio A. That's it. No, I will be having multiple options. Then at the finally, I will be selecting the suitable option for me based upon my preferences. So when there is a condition, when there it is even in front of you, there is a option to choose the portfolios, then the selection of a portfolio by comparing between these combination of portfolio is considered to be efficient frontier based upon certain techniques. So efficient frontier is the net of optimum portfolio that offers. So when it comes to efficient portfolio, that particular portfolio should be giving you the highest expected return for defined level of risk, or it should be having a very lowest risk for a given level of expected return. So to put it together, Markowitz found a way to pick the most optimum portfolio. But when we can do it? When we are having more options in front of us. So that I will be comparing it. So out of this comparison, how I can first of all compare it and how I will be finding it which is the most efficient. So for that is the term is efficient frontier. So what we're going to do is we out of all the options, we will be finding one option, the net optimum portfolio. So what this particular portfolio that we choose should be like, it should provide us the highest expected return. That is what we want, right? So highest expected return for a defined level of risk. Moving forward, so one, how we should pick the portfolio. A portfolio is not efficient if there is another portfolio with highest expected value of return and less standard deviation. We already discussed variance or standard deviation is considered to be riskier. So suppose I just pick the portfolio A and then there is another portfolio which is providing a highest expected return. Then obviously I don't want this option, right? When we are going to see the sums, it will be clear to you. So this is how efficient frontier works. So let us jump into the graph and it will be more easy for us to understand. So consider this graph, x-axis and y-axis. So we are having a return and our risk. So return is the expected return. That is why we are having RA is your return and A percentage is the expected. How much is the expected? So it is the weightage. So this is expected return and risk sigma is the risk. So considering this too, if I plot it in the graph, you can see I can join few of the portfolios and the blue line indicates it is efficient front. Anything falls on this line is considered to be efficient. You should pick that. That is, this is the portfolio which is going to yield you highest return and less risk. And also you can see there are a few options. These red dots are the collection of investments. So suppose this is portfolio A, this is portfolio B, C, D, E, F. So those, if you see E and F falls upon the efficient frontier, so it is the optimum portfolio. So you can go for it. Those which are above efficient frontier, that is A, B, C, D, this will be having higher risks. Also those which are below the efficient frontier, let us consider J. It is also not optimum. So anything falls upon the efficient frontier is the optimum portfolio and one should pick that. So portfolio falls outside EF is considered as suboptimal. It is not optimal, so it is suboptimal. Portfolio lies below efficient frontier does not provide enough return compared to the level of risk it is taken. So the risk will be high, whereas comparatively the return will be low. So it is not good to go for that portfolios which fall below the efficient frontier. Similarly, when it goes up, you may think, okay, I'm going to get a more return, but no. The level of risk you're going to take and the return comparatively it won't be a good choice. So it is the optimal choice is those portfolios which is on the efficient frontier. So these are called optimum portfolios. The one which is being rounded by the green circles or the optimum portfolio, and you should go for that. Okay. So now, what is the optimum portfolio? How to find it? Or the portfolios that fall above the efficient frontier is said to be optimum portfolio. It means if you already saw this is the graph, and this is my efficient frontier, and any portfolio which falls on this line is considered to be optimum portfolio. The optimum portfolio of securities will vary considerably among investors. So, as we discussed earlier, each investor's preference differs. So it doesn't matter if for one investor if portfolio A is the correct option, it doesn't mean that for the A is the correct option for the other investor. So it depends. So finally, diversification. How to do a diversification? So diversification is the process which combines assets that are less than perfectly positively correlated in order to reduce portfolio risk without sacrificing any portfolio return. So there should be a combination of risk and return. At the end of the day, it should be yield the return to the taxable person. Suppose I'm having two stocks in my bucket. So if one stock is not performing well, the other stock should at least build a cushion for me. If that doesn't work like that, if both the stocks going to collapse at the same time, then it is not a good thing. So that is why we are saying there should be a trade-off between risk and return through diversification. So the portfolio should consist of the stock that one stock gonna fall, the other stock should somehow save. So that can be achieved through diversification, which will be discussed in deep in the upcoming videos. So as of now, consider diversification as a process which combines assets that are less than perfectly positively correlated. We will be having one separate session discussing perfectly positively correlated. So in order to reduce portfolio risk without sacrificing any portfolio return. Going to second point, in order to increase the efficiency of investors' portfolio, increase expected value of return without increasing the risk. So how a portfolio manager should work, or how an individual is taking care of the portfolio, how they should work is they should increase the expected value of return without increasing their risk. So combination of the return and risk should be in a way that the return is high whereas the risk is less. Let us take a couple of minutes to just go through the summary of today's video. So in today's video, we just talked about the portfolio management theory. So under which we saw about efficient market hypothesis. So this is nothing but you will be checking the stock market movement based upon the stock prices and their dependent information. So based on which the market's efficiency can be divided into three types. One is weak, another one is semi-strong, and finally strong based upon the information those stock prices hold. And secondly, we just saw the random walk theory. As name suggests, it states that the stock price movement will be in a random and a patternless manner. So anyone who is going to consider these stock prices to take the decision, it won't work. So that is mean by random walk. Finally, we have just saw the theory Markowitz model of risk return optimization. So under this, we just saw who is the founder of this model and the basis on which this model works, and the application at the end, what we require from this, why we use this model, and what we require out of this model is to select the optimum portfolio, and the assumptions. The assumptions are really important, the assumptions. And finally, we are having the efficient from type. So which is a graph. So based upon this graph, so we will be deciding which is our optimum portfolio, and this graph's variable is risk and return. And also we saw diversification. So by this, I'm gonna close this today's video. Thank you for watching.